Mention the objectives of financial management. What are the objectives of financial management? Working capital refers to that part of the firm's capital which is required financing short-term depreciate the machine under straight line method. The company is taxed to be at 25%. CBDD, cash inflow before division and taxation given 12 lakh, 12 lakh, 15 lakh, 10 lakh, 10 lakh. Hello, my dear students. I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram, First Grade College, a Temple of Excellence, MYSURU. Today, I am going to hand Financial Management 5th Semester BCom of question paper scheme. I will take the question from the different question paper. I am going to answer that definitely help you from the examination of point of view. So I took all the questions from the question paper which are important that I am going to solve now. Hope this will definitely help you. We'll move on now. Total mass, what's called pattern of the question paper. Here, 2 marks question, they will ask 7. You have to answer any 5, each carrying 2 marks, 2 into 5, 10 marks. This goes in favor of section A. Section B, we ask 4 questions, 10 marks question, we'll ask 4 questions. You have to answer any 2 questions, maybe 2 practical, 2 theory is there. We can attend the practical only or we can attend the theory. So 2 into 10 is 20 marks. Section C, we ask 4 questions. You have to answer any 2 questions. 15 into 2, 30. Totally 60 marks coverage. Others are internal. So we'll go with section A. 2 marks questions and answer. I will go detailing one by one. Question and answers are there. Mention the objectives of financial management. What are the objectives of financial management? Number 1, basic object, maintenance of liquid asset, profit maximization, wealth maximization. Then other objectives, ensuring regular and sufficient supply of capital to the business, ensuring a fair rate of return to the suppliers of capital, ensuring better utilization of capital by following the principles of liquidity, profitability, and safety, then coordinating the activities of those of the other department of the enterprise. So, what is the objective of financial management? Then, state the 2 techniques of time value of money. The 2 techniques of time value of money is nothing but discounting present value method, compounding future value method. So, 2 methods are present value method, future value method. What is capital structure? Capital structure refers to the proportion of different kinds of securities raised by a firm as long-term finance according to C.W. Gerstenberg. The types of security to be issued and proportionate amount that make up the capitalization known as capital structure or financial structure. Here the word is the type of security, which types of security issued and proportionate amount. What are the amount you have invested made the capitalization known as financial structure or capital structure. Then 4th one, using rule, find how many years the amount of rupees 4,000 will be doubled at 12% rate of interest. Years to double, formula 12 divided by rate of interest. So 72, what's the rate of interest is 12. So it takes the 6 years. Very simple, 2 marks. Then what is payback period? The term payback period refers to the period in which project will generate the necessary cash to recover the initial investment. So whatever we have invested, how much money we can get back, the whatever we have invested in how many years, we can get back particular money. Mention the types of working capital. The types of working capital are gross working capital, net working capital, permanent working capital, temporary or seasonal working capital, positive working capital, negative working capital. So which are that is? Gross working capital, net working capital, permanent working capital, temporary or seasonal working capital, positive working capital, negative working capital. Then What is the present value of rupees 11,664 at 8% interest per annum for 2 years? Formula: present value is equal to future value divide 1 divided by 1 plus r to the power of n. R means rate of interest. Present value is equal to 11,664 divided by 1 divided by 1.08. How many years? 2 years. So the answer for this is, we'll get the 10,000. Who is finance manager? A finance manager is someone who oversees the financial health of an organization and helps to ensure financial substantiability. According to Myers, financial manager refers to anyone who is responsible for a significant investment or financing decision. Any financing decision depends upon the financial manager. What do you mean by working capital? According to J.S. Mill, working capital means a sum of current assets. Working capital refers to that part of the firm's capital which is required financing short term. This is very short term, or current assets such as cash, marketable security, debtors, and inventory. Inventory is nothing but stock. Using Rule 69, calculate the doubling period of rupees 95,000 at 8% interest per annum. According to Rule 16, doubling period is equal to 0.35 plus 69 divided by rate of interest. So according to this 69, 0.65, 69 by, what's the rate of interest is 8. 0.35, 69 divided by 8 is 8.625. If we add no, it becomes 8.975. What is the optimum capital structure? Optimum capital structure may be defined as the capital structure or combination of debt and equity. It's a combination of debt and equity. Debt means a loan. That leads to the maximization the value of the firm and minimize the firm cost of capital. In short, an optimum capital structure is the best debt to equity. We take the debt and the equity, maybe more debt, less equity, or more equity, less debt for a firm that maximizes its value. The 12th question goes like this. What is the future value of rupees 15,500 at 9% interest compounded annually for 3 years? He wants to know that what's the future value. There are two values. One is called the present value, one is called the future value. Future value is equal to present value into 1 plus r to the power of t or n. Future value is equal to, what's the value? 15,500 into, what's the percentage? 9. 9 means 0.09. 1 plus 0.09 to the power of 3. This is future value 15,500 is 1 plus 0.09 to the power of 3. This is 15,000. We can write this also. 1.09 to the power of 3. Then 15,500 into 1.03 to the power of 3 is nothing but 1.2950. The answer is future value 20,072. That means if you present 15,500 for 3 years at 9%, the value becomes 20,072. Move on. 13. What is the main technique used to evaluate the capital budgeting? A. Traditional method, non-discounting method, payback period method, accounting rate of return. Modern method, discount methods, discount payback method, net present value method, internal rate of return method, profitability index method. 14. What is leverage? What are the types of leverage? The term leverage refers to the relationship between two interrelated variables with reference to a business firm. These variables may be cost, output, sales, revenue, EBIT. EBIT means earning before interest and taxation. The types are operating leverage, financial leverage, combined leverage. 15. What is cash management? It is a process of managing cash inflows and outflows. The ultimate goal is to maximize liquidity and minimize the cost of fund. What is receivable management? The management of an amount owed to a business by its customer. Who has to pay? The customer has to pay. Customer buys the goods and services from the company on credit. When the customer buys on the credit, customer becomes the debtor and the seller becomes the creditor. The amount payable by customer on credit sale is called account receivable. So account receivable to a owner. So owner becomes the creditor. and the person who purchased the customer becomes the debtor. Then 17. What is inventory management? The process of ordering, storing, using, and transferring of a company's inventory. It includes management of raw materials, components, and finished product, including warehousing and processing of such items. So, inventory means stock. The process of ordering, storing, using, and transferring of a company's inventory. It includes management of raw material, components, and finished product, including warehousing and processing of such items. So, all this goes to section A. Now, we'll enter to section B, almost practical questions. 10 marks each. From the following detail, calculate operating, financial, and combined leverages and earning after tax. Contribution per unit is rupees 40. Fixed cost is 24 lakh. Output is 1 lakh unit. Interest on loan is 2 lakh. Tax rate is 30%. First, what is your contribution? So sales minus variable cost is called contribution. Contribution 1 lakh into 40 is 40 lakh. Your fixed cost is 24 lakh. If we deduct this 24 lakh, your EBIT is 16 lakh minus interest they have given 2 lakh. So if the interest goes now, what is left over? EBT, earning before taxation is 14 lakh. On that 30% is 4 lakh 20,000. Earning after taxation is 9 lakh 80,000. This is the format you have to fill up. Now, we'll have the formula for that. What is operating leverage? Contribution divided by EBIT. That is 40 lakh divided by 16 lakh is 2.5 times. What is financial leverage? EBIT divided by EBT. 16 lakh divided by 14 lakh. The workout 1.14 times. Then combined leverage, the answer of operating leverage, answer of financial leverage should be multiplied. 2.5 into 1.4, it works out 2.85 or 2.86 times. Now, go to second one. January 2024, Naveen Limited produced and sold 10,000 units. Selling price is 100 rupees per unit. Variable cost is 60 per unit. Fixed cost is 1 lakh per annum. The company's capital structure consists of 1 lakh equity share of 10 each, 8% debenture of 8 lakh, and 10% preference share of 5 lakh. Tax rate is 30%. Calculate operating leverage, financial leverage, combined leverage. Now, says 10,000 into 100 is 10 lakh. Your variable cost is 65. 10,000 into 65 is 6 lakh 50,000. Your contribution is 3 lakh 50,000 minus fixed cost is 1 lakh. Your EBIT is 2 lakh 50,000. Interest on debenture on this is 8 lakh at 8% is 64,000. Your EBIT is 1 lakh 86,000. Tax on that 30% works out 55,800. Your earning after taxation is 1,30,200. If you answer this operating leverage, contribution divided by EBIT, 3,50,000 divided by 2,51.4 times. Financial leverage, EBIT divided by EBT, 2,50,000 divided by 1,86,000, 1.34 times. Your combined leverage is 1.4 into 1.34 is 1.876. A project involves an investment of rupees 32,400, life of 4 years. Cash flows are expected to be as under. Here, 1, 2, 3, 4. Inflows are 16,000, 14,000, 12,000, 9,000. Calculate IRR. IRR means internal rate of return. At rate 8% and 10%. The discount factor at 8% is 0.926, 0.857, 0.794, 0.735. At 10%, 0.909, 0.826, 0.751, 0.683. So this goes in the favor of 10%. This goes in favor of 8%. This is nothing but a formula. 1 divided by 1 plus R to the power of n. IRR is equal to internal rate of return. IRR is equal to A plus C minus O divided by C minus D into B minus A. What is A? Lowest trial. What is C? Cash inflow of highest value. What is O? Original investment. What is the cash inflow of lowest value? B minus A is difference in trial. If you go with cash inflow, 1, 2, 3, 16,000, 14,000, 12,008. Discount factor 88%, they have given 0.926, 0.857, 0.794, 0.735. If you multiply this, it is 14,816, 11,998, 9528, 66. Total it will work out 48,957 at 8% discount factor. You go discount factor at 10%. 4 years flows 16, 14, 12, 9,000, 0.909, 0.826, 0.751, 0.68. Multiply 14,544, 11,564, 9012, 6147, for totally 41,267. So, if you calculate, IRR is 8. This is highest value is 48,957. Cost of investment 32,400. Then 48,950 highest value minus lowest value. Difference means 10 minus 8 is 2. The answer is 20.49%. This is your IRR. But here only thing here, no, in examination, no, 4 years in cash are expected to be. So they ask if it's only for 3 years. Life is 4 years. If they ask only for 3 years, what would have been the answer? If they ask only for 3 years, if it's a 4 years, no problem at all. If they ask only for, if the economic life is expected to be only 3 years, if they ask, then I took at 15% for 3 years. 16,000, 14,000, 12,000 at 15%. How to calculate this 15%? I will tell you once again. This is 0.870, 0.756, 0.658. If we multiply this 1350, totally 32,400 total present value. Your cost price also 32,400. Your net present value will come 0. So therefore, we can say that IRR would be 15%. This we have to do. If they give the 4 years, we are doing for 3 years. But I took at 15%, it becomes 0. Maybe other percentage also you can take. You have to do it, the problem. Okay, discount factor, I will explain. 8%. How to do this is 10%. 1 divided by 1 plus r to the power of n. This is 1 divided by 1 plus 0.10 to the power of n. So 1 divided by 1.10 to the power of 1. If you go with the calculator, 1 divided by 1.10 is equal to 1 divided by 1.10 is equal to 0.909. 0.909. Then for a second year, don't calculate, put the equals here. Second year it will come 826, it will goes on like this. Third year it will goes like. So we can usually, this is 1 divided by 1 plus r to the power of. For this 8%, 1 divided by 1 plus 0.08 to the power of n. Same procedure you have to follow. Okay, hope you understand. This we have done with the assumption. If you take for 3 years, because they are doing for 4 years, if they asked to do the 15 years, I took at 15%, I have done. That's all. So it is equal to 0. So then it would be IRR, internal rate of return is 15%. Ajay invested rupees 25,000 in a bank at 10% interest compounded for 2 years. Calculate amount to be received, interest compounded annually, semi-annually and quarterly. So they asked me how much invested 25,000. What is the rate of interest? 10% for how many years? 3 years. Future value is equal to present value into 1 plus r to the power of n. What is your present value? 25,000 into 1.10 to the power of 2 years. So 25,000, 1.21 is 30,250. That I am applied annually. Present value into 1 plus r to the power of n. 25,000 into 10% means 1.10 to the power of 2. 25,000, 1.10 to the power of 2 is 1.21. Multiply, you'll get the 30,250. That goes half yearly. Half yearly means once in a year 2 times, for 2 years 4 times. 0.10 divided by 2 into 4. That is 25,000 into 1.05 to the power of, this is 1.05 to the power of 2 into 2. So it works out 25,000 into 1.1025. So the answer is 30,387.50. Come back here. Quarterly 0.10 divided by 4, 2 years. So in 1 year 4 times, 2 years 8 times. So 25,000 into 1.025 to the power of 8, 25,000 into 1.2184, it works out 30,460. So definite question they ask. One question for a future value. This is annually, this is half yearly, this is quarterly. Half yearly means 4 times, quarterly means 8 times, yearly means 2 times. Now, I'm going to solve the problem for 15 marks. We already solved the problem of section A for 2 marks question. We already solved 10 marks question. Now we are going to enter for 15 marks. So they will ask the 4 question. 1 theory, 3 problem. You have to answer any 2, that's all. So what is that? They will ask 4 problem. 4 totally we have to answer. They will ask the 4 question. 1 theory, common theories are what are the factors which determine the working capital, or what is financial management, explain its functions, advantage and disadvantage. This is a very common question they are going to ask. Another 3 problems. One on working capital, one on capital structure, one on capital budgeting. Today we move on. This goes in favor of working capital. Estimate the working capital required of XYZ company for the year 2022 from the following information. Estimated production is 2,08,000. This is important. Unit. Estimate the ratio of cost to selling price, rupees 80. So your cost based on selling price. So raw material 50% of 80, direct wages 10% of 80, manufacturing overhead 15% of 80, selling overhead 10% per unit of 80. So we'll move on. Raw materials are in stock an average of 2 months before production. Every unit of production remain in process. This is important. And an average of 2 months. Finished goods remain in stock for 4 months. Credit period allowed by creditor is for 3 months. Credit period allowed to debtor is 2 months. Time lag in payment of wages 2 weeks. Time lag in payment of overhead is 1 month. 20% output for cash. Both production and sales are in regular basis. Assume that 4 weeks in a month and 52 weeks in a year. When they are given like this, you convert all the month to weeks. In a 1 month, there are 4 weeks. So because based on the weeks, you have to solve the problem. That's the first point. So when the weeks are given, you convert all the month to weeks. Here, example, see that. Average 2 months means 8 weeks. Here, 2 months means 8 weeks. 4 months and 16 weeks. Like this. Now, come back to this. So cost of raw materials. How he says? 50% of rupees 80 based on sale. 50% of rupees 80. So it works out 40 rupees. This goes in favor of raw material. Then wages. %10 of rupees 80. 8 rupees. Then manufacturing overhead. Manufacturing overhead. This is 15% of rupees 80. 15% means 12 rupees. Then selling overhead. %10 of rupees 80. 8 rupees. Add. So 48, 50, 60, 68. Total cost. Profit. Sales is 80. Difference 12 rupees is the profit. Profit should not be considered. So here manufacturing, selling overheads are there, no? Here. So you must have that idea. So finished goods like this. Here, no? Finished goods. Based on cost of production. This you have to remember. Then here 20% cash sales means 80% credit sales. So this is you have to remember. So if you go with the working note, cost of material 50% of 80 is 40, wages 10% of 80 is 8 rupees, manufacturing over 15% of rupees 80, 12 rupees, selling over 10% of 80, 68 is the total cost. Then your selling price is 80, so difference is 12. Then finished goods based on cost of production, 20% of cash sale, 80% credit sale. We'll go with win. Raw material in stock an average of here 2 months means 8 weeks. So 2,08,000 divided by 52 into 40 into 80 is 12,80,000. Work in progress means you have to take raw material 100%, labor 50%, overhead 50%. Raw material 2,08,000 divided by 52 into 8 into 40, 12,80,000. Direct labor 2,08,000 divided by 52 into 8 rupees, half you have to take 1,28,000. Manufacturing overhead 2,08,000 divided by 52 into 8 into 12 rupees into half 1,92,000. Totally it works out 16 lakh. Then stock of finished goods on the total cost price 68. 2,08,000 divided by 52 into 68 into that is 16 into 43,52,000. Debtor 20% means 1,5 is the cash sale, means 4,5 is the credit sale. So debtor 2,08,000 divided by 52 into 68 into 8, it works out 17 lakh. This is here 19 lakh 20,000. Then here debtor here 40,000. So we'll come back here. Then current liability, creditor on raw material. Creditor on raw material 12,08,000 divided by 40 into how many months are there? Creditors 2 months. Creditor is 3 months and 12. This is 2,08,000 divided by 52 into 12 into 40. So it works out creditor 2,08,000 into 40 into 12 divided by 52, 19 lakh 20,000. So debtor is 17 lakh 40,000 totally. Then current liability, this is 19 lakh 20,000. Outstanding wages 2,08,000 divided by 52 into wages is 8 into that is outstanding wages. Credit allocated. Time lag in wages 2 weeks. He has given 2 weeks. 2 divided by 52 at the rate of 8, 2,08,000. It works out 64,000. Outstanding manufacturing overhead. Overhead is 1 month, means 4 weeks. Outstanding manufacturing 2,08,000 into 4 divided by 52 into 12. It works out 1,92,000. Outstanding selling overhead 2,08,000 divided by 52 into 4 into 8. 1,28,000. If you add all these, 23,04,000. Totally it will come 66,68,800. This is net working capital required. So there is no contingency. If there is any contingency is there, that should be added on. If there is a 10% is there, no 10% on this, then it becomes the total working capital. Hope you understand. But only work in progress, raw material 100%, labor 50%, overhead 50%. Okay. Then we'll move on to next problem. This goes to capital structure. Raj Limited has 1,50,000 equity share of 10 each. It plans to raise additional capital of rupees 25 lakh. This is important. Additional. And has the following option. To issue 1,50,000 equity share of 10 each means 15 lakh. Totally how much you require? 25 lakh. Then 75,000 10% preference share 10 lakh means 7,50,000. 25,000 of rupees 10 lakh, 2,50,000. So 1,50,000 means 15 lakh, 7,50,000, 2,50,000, totally 25 lakh. Issue 25,000 equity shares of 10 each means that is 2,50,000. 1,50,000, 12% preference share each means that is 15 lakh. 75,000 of 10 each means 7,50,000. So totally it works out 25 lakh. To issue 1 lakh, 10% preference shares of 10 each means 10 lakh. Then 1,50,000, 10 each means 15 lakh. So 10 lakh plus 15 lakh is 25 lakh. Your EBIT is 12 lakh important. The tax rate to be 30%, determine the earning per share and suggest which companies to be accepted. We'll go slow now. So there are three options, option A, option B, option C. Come back here, option A. So here, 1,50,000, one is equity, one is here, one is equity, one is preference, one is debenture. So equity here, preference share is there, debentures are there. This is the first option. Second option, we have got equity share, we have got preference share, we have got debenture, equity share, preference, then preference share and debenture. Last one, you have got only preference shares and debenture. Preference shares and debentures here. Okay. What's your EBIT? 12 lakh, 12 lakh, 12 lakh. Then option interest on debenture. Where you have debenture here, how much debentures are there in the first case? Here, 10% debenture of 10 each. Here, option A, interest on debenture. Option A, 1,50,000 shares of 7% each. Then 75,000, 10% preference share 10 each. 25,000, 10% debenture of rupees 10 each. So 2,50,000 into 10% means 25,000. Second, we have got debenture 7,50,000, 10% means 75,000. Third case, option C, 15 lakh, 8% is 1,20,000. This is your EBIT. Your EBIT is 12 lakh, 12 lakh, 12 lakh. So 25,000, 75,000, 1,20,000. How much? If you deduct this, no, it becomes 11,75,000, 11,25,000, 10,80,000. This is called earning before taxation. So on this, you have to put the tax of 30%. 30% on this, 3,52,500, 3,37,500, 3,24,000. If we deduct, earning after taxation become 8,22,500, 7,87,500, 7,56,000. Now, less preference dividend. Option A, we have got a preference share capital 7,50,000, 10%. Option B, you have got 15 lakh, 12%. Option C, you have got 10 lakh, 10%. So 75,000, 1,80,000, 1 lakh. If we deduct no, 7,47,500, 6,07,500, 6,50,000. This is the profit available to equity shareholder. What is this? Profit available to equity shareholder. Now, earning per share, profit divided by number of shares. So you have got 7,47,500. What is your existing? Already you have got 1,50,000. Here 1,50,000 equity share means totally you have got 3 lakh share. Second one, You have got 1,50,000. So 1,50,000 equity share come back here. You have got 25,000. That means it become 1,75,000. Third case, only there is no equity share at all, preference share and debenture. So it is only 1,50,000. If we divide 7,47,500 divided by 3 lakh, it works out 2.49 per share. It works out 3.47 per share. It works out 4. So this case is accepted. Higher suggestion. Option C is advisable. Option C is advisable. Whichever is highest, that should be taken. That format you have to learn. First one, EBIT minus interest on debenture. See that? This format you have to write. EBIT minus interest minus tax minus preference dividend available to equity shareholder divided by number of equity shares. Hope you understand. I solved very clearly here. You have to write like this. Preference dividend you have to write like also. This goes to debenture interest. This goes to preference dividend divided by number of shares. Existing plus new. Existing plus new. Last one. This goes in favor of capital budgeting. $15 marks. Definite question. Definite question. Definite question. Y Limited wants to install a machine at a cost of rupees 30 lakh with a life of 5 years with a salvage value of rupees 1 lakh. So this is called residual value. Depreciate the machine under straight line method. The company is taxed to be at 25%. The estimated earning before depreciation and tax, that's EBDT, with their PV factors. EBDT is 12 lakh, 12 lakh, 15 lakh. This is cash inflow before depreciation and taxation, PV factor. So before solving the problem, the method is CBDT, cash inflow before depreciation and taxation, minus depreciation, minus taxation, add back your what's called depreciation, that is your cash inflow. How to calculate cash inflow? CBDT, cash inflow before depreciation and taxation, minus depreciation, minus taxation, that is your net profit or cash inflow after taxation, add back depreciation, that is your cash inflow. Then depreciation, there are two methods. One is called straight line method, one is called diminishing method. Here they ask straight line method. Cost is given, salvage is given. What's the formula? Depreciation is equal to cost minus salvage value divided by life of the machinery. What's the formula? Cost minus salvage divided by life of the machinery. See that? Depreciation is equal to cost of the asset minus salvage value divided by life of the asset. What is your cost of the asset? 30 lakh. What is your salvage value? 1 lakh divided by 5. It works out depreciation 5,80,000. That remain constant. Straight line meaning depreciation remain constant. We'll go. Determination of PV of the cash inflow. CBDT, cash inflow before depreciation and taxation given 12 lakh, 12 lakh, 15 lakh, 10 lakh, 10 lakh. Minus depreciation, straight line method, depreciation remain constant. 5 lakh 80, 5 lakh 80, 5 lakh 80, 5 lakh 80. If we deduct, it comes to 6 lakh 20, 6 lakh 20, 9 lakh 20, 4 lakh 20, 4 lakh 20. On this 25% tax, it works out 1,55,000, 1,55,000, 2,30,000, 1,05,000, 1,05,000. What's our balance now? 4,65,000. This is cash flow after taxation, or we can say that net profit. 4,65,000, 4,65,000, 6,90,000, 3,15,000, 3,15,000. Then add back depreciation. 5,80,000, 5,80,000, 5,80,000, 5,80,000, 5,80,000. It works out 10 cash inflow, 10,45,000, 10,45,000, 12,70,000, 8,95,000, 8,95,000. Discount factor at 12%, 0.892, 0.797, 0.711, 0.635, 0.5. Multiply 10,45 into this, it will work out 9 lakh 32 140, 8 lakh 32 865, 9 lakh 2,970, 5 lakh 68 325, 5 lakh 7,465. If we add all these things, it will come 37 lakh 43,765. Add salvage value 1 lakh, that here discount factor is 0.567. Last one, if you want it will come 56,700. Add this is total present value 38 lakh 465. This type we have to do it. Very carefully you have to do, but very simple. We have to do like this. Then payback period. You have got 30 lakh. In how many years we can get back that money? First year, how much you got? 10 lakh 45,000. Second year also 10 lakh 45. It become 20 lakh 90,000. How much shortage now? 9 lakh 10,000 is shortage to become 30 lakh. Answer, cost rupees 30 lakh. First year 10 lakh 40, second year. So how much already received? 20 lakh 90,000. How much shortage? 9 lakh 10,000. You have to take 9 lakh 10,000 from how much money? 12 lakh 70,000. 9 lakh 10. How many years over? 2 years. 9 lakh 10,000 divided by 12 lakh 70,000. It works out 0.7165, or we can say that 2.72 years. We can get back your money in 2.72 years. Then calculation of average rate of return. Average rate of return is called average profit divided by average investment. So your average rate of return is called to, you have to calculate this one. Your total profit as per the problem is 22 lakh 50,000. How many years are there? 5 years. If we divided it, your average profit become 4 lakh 50,000. Average investment. Your original investment plus a salvage value whole divided by 2. What's your original investment? 30 lakh. Your salvage value is 1 lakh. Divide by 2, it will work out 15 lakh 50,000. So if we deduct 4 lakh 50,000 divided by 15 lakh 50,000, the percentage you can be 29.93. By chance, if we take only 30 lakh, 4 lakh 50,000 divided by 30 lakh into 100, that works out 15%. Or 15.52%. If it does not take the salvage value. Then calculation of average rate of return, that we already solved. Determination of NPV. NP, present value of the total cash inflow minus investment. What is your total cash inflows? 38 lakh 465. 38 lakh 465. What is the cost of the asset? 30 lakh. How much NPV is there now? Here, NPV is equal to 8 lakh, here 8 lakh 465. Okay, option. Determination of this. NPV is positive. NPV 38 lakh, right? This is positive. 8 lakh 465. Determination of profitability index. Profitability index is cash inflow divided by initial investment. What is your cash inflow? 38 lakh 465 divided by 30 lakh, it comes to 1.267 advantage. You have got 1.267. Then there is a point here. Here we can do that also. There are some authors, they can do original investment plus salvage value divided by 2. Some of the authors says original investment minus salvage value divided by 2 also they will do. Once you go with a plus, once you go with a minus, that's all. Here 30 lakh minus 1 lakh 29 lakh divided by 2 they will do here. Generally we can go with a plus. 30 lakh plus 1 lakh divided by 2 I have done. We can do like this also. 30 lakh minus 1 lakh divided by 2 also we can do. But some of the authors says only they will take only 30 lakh. 30 lakh divided by your average profit of this. No, here I have done. See that? I have done 30 lakh plus 1 lakh 15 lakh 50,000. 4 lakh 50, 15 lakh into 100 they will do. Another way, directly we can do for this 30,000 only. We can do that also. There are some authors, they will say only 30,000 they will take into consideration. There are some authors, they will take this 1 lakh divided by 2. What's the total present value? 38 lakh 465. Cost of the asset is 30 lakh. So positive is 8 lakh 465 in PV. Determination of profitability index. So your total cash inflow is 38 lakh 465 divided by 30 lakh. It works out 1.267. I solved all the three problems here. So one on working capital, one on capital structure, one on capital budgeting. From the examination point of view, definitely it will help you. Out of the three, so you have to solve the two questions. One theory question will come. What are the factors which determine the working capital? Or what is financial management? Explain its function, advantage and disadvantage. Difference between financial accounting and management account, they may say. But generally, they will ask what is financial management, explain its function, then role of financial manager. They may ask. So, common question: what are the factors which determine the working capital? If you are good in practical, we can solve. We can leave the theory. We can go with the problem. The problems are one working capital, one capital structure, or one working capital, another capital budgeting. You choose anyone. From the examination point of view, I solved all the three problems. Section B also I have solved. Section A theory is given. You go to that theory totally. All the questions which have been taken from the question bank, it has been answered. In the 2 marks question, you have to give the more important rule number 72, rule number 69 will come. Present value and the future value will come definitely, because this is a common question they are going to ask. What is working capital? What is financial management? What is capital structure? Very common question they are going to ask. I answer all that. Another point, they may ask what is cash management? What is inventory management? That is very common question they are going to ask. Hope you understand. I try my best to solve all types of problems here from the examination point of view. Hope it will do well for you. So I will say that the coming exam is on 24th. Please go through this. Definitely, somewhat, some extent, these problems which have been solved here may help you from the examination point of view. I say best of luck in the coming examination. Hope you bring the good result to what's called good marks and score the good marks and bring the good result to and bring the name of your parents, your institution, and also your teacher. Best of luck in the examination. Please go through 1 or 2 times. Definitely, it will help you. Thank you. Thank you very much.